Hello, this is Brian Rezny, president of Rezny Wealth Management. We've got a great show for you again this Sunday, as we always do. Make sure you do visit my website, ReznyWealth.com. And of course, you can go there and sign up for instant email alerts about the economy, the markets, what you should be doing with your money, and how you can avoid Wall Street, the annuity charlatans of the world, and so on. If you want to protect your portfolio, if you want real money management, which includes risk management, and avoid all the crummy Wall Street firms, the banks, the insurance companies, people that work against you and your money. You want real advice, you want to learn how to protect yourself, go to ReznyWealth.com. Download any of our free reports or sign up for instant email alerts about the economy and the investment markets so you can make better choices around your retirement and protect your money and prosper in any economy. I'm going to talk a little bit about, why you're not making money today. I get a lot of questions from investors. Brian, I'm not making money. I'm going to discuss why you are not making money and ultimately what hurts your portfolio. A few rules that I like to follow. I like to teach investors not only my TV, but also my radio show. Remember, I have a 2-hour live radio show every Sunday, 10 a.m. to noon. Go to ReznyWealth.com for times and availability. But you're not making money, and why? Ultimately, there's 3 big keys that I look at for investors. And you, as the investor, have to realize rule number 1, never get married to your investments. You're going to buy an investment, hopefully because you have an investment strategy that you've developed. Don't rely on your Wall Street firm or bank or insurance agent to have an investment strategy, because most of these firms, you have a brokerage account. They're actually not managing anything. They're selling you investments. You're ultimately responsible. So if you're working with one of these firms or you're doing it yourself, you need to first, obviously, develop an investment strategy. Then you research your investments, and then your investments go into your portfolio. But never get married to an investment. An investment right now that a lot of people are calling my TV and radio show about is Apple Computer. Well, Brian, should I buy Apple Computer? It seems like it just always goes up. And I always try to explain to investors, things go up until they go down. And they can go down hard, and they can go down for a long period of time. There's been multiple times Apple's dropped 30, 40, 50% in value. You would have lost a lot of money. There is no investment in the world that is buy and hold. You might buy it today and hold it for 5 or 10 years, or you might buy it today and sell it in a year because the fundamentals change. So remember, never get married to your investments. Don't buy an investment because you've heard of the company or you work for the company. Do research, but have a sell criteria. By getting married to an investment, you ride an investment that starts going down often 40, 50, 60, 80%, or maybe to zero. Know when to sell. Number 2, the trend is your friend. Utilize a 50 and a 200-day moving average at a minimum. And all that means is a trend. Is the trend moving up, or is the trend moving down? The 50-day moving average takes a look at the average price for the last 50 days of that, let's say, particular stock, Apple Computer. The 200-day is the average of the 200-day average of, let's say, Apple stock or any stock. You want the daily price to be above the 50 and the 200-day moving average. That means you're relatively strong and in an uptrend, and chances are it may continue. If that stock price daily goes underneath the 50-day moving average, that's a warning sign. It doesn't mean necessarily a sell, but it's a warning sign. If the daily price crosses below that trend, keeps going down and crosses the 200-day, that is often a good criteria to sell unless you have other criteria within your investment strategy. So again, trends last often for long periods of time, years, maybe decades, either positive or negative. A trend is your friend. Follow the trend of the investments you own, and it may alert you when it's time to sell before you lose half of your money. Rule number 3, changing fundamentals. Every company goes through changes of fundamentals. It's interesting. I look at, I've been managing money for 28 years. I've had literally tens of thousands, if probably not hundreds of thousands of questions on my TV or my radio shows over the years. And people will often say, well, you could buy XYZ stock. That's never going out of business. And it goes out of business and you lose your money. If fundamentals change, either for a positive or negative, that could be a reason to buy if they become positive, and it could be a reason to sell if they become negative. Fundamentals matter. Fundamentals are the earnings, the revenue, the growth of the company that you own. If it's not growing, then it's probably going down. If it's going down, that means the equity price is going down. And it can go down for years, as I alerted earlier. Make sure you know when to sell. If you don't, or your broker or so-called advisor doesn't, then call my firm for a consultation. We know how to manage risk. We know how to manage a portfolio. So make sure you look at those 3 rules and make sure you follow them in order to help prosper within your portfolio and reduce risk. Plain and simple, we are in a bull market right now in the U.S. economy. At my firm, we're mainly invested in U.S.-based equities for the growth part of our portfolio, quite a bit in small and mid-cap, which are the higher earning areas of the general market. Remember, I talked earlier, fundamentals, earnings often drive stock price. A recession, this bull market's going to continue until we see a recession starts to appear on the horizon. How do you know when you're going to have a recession? Go to my website. Sign up for an instant email alert. I'll alert you when the economy is starting to change. Also, stocks become ridiculously overvalued, like they did in 2000. By the way, we see no recession right now in the U.S. Things are growing at a nice, slow pace. And we also do not see an overheated stock market, meaning valuations in 2000, by the way, the S&P was trading at about a 35 to 38 PE ratio. Right now, the S&P 500 is trading at around about a 16 to 16.5 PE ratio. We don't see any bubble. We don't see a recession. We're fully invested, and our clients are happy we are. But again, that may change next week, next month, or next year. What is your sell strategy? Or are you going to fall prey to your Wall Street broker? Hold on. Things will come back like they did in 2008 and they did in 2000. Never buy and hold. Sell when you need to when the fundamentals change, recessions appear on the horizon, or stocks get crazy overvalued. If you have questions about your portfolio, send them to Brian Rezny at ReznyWealth.com. I'll answer them on my TV show. You can also, of course, call my live radio show every Sunday from 10 a.m. to noon and get a question answered there as well. Larry in Fort Myers, Florida. I own a variety of corporate bonds. These bonds were purchased years ago and have yields ranging from 6 to 7.5%. According to the holder of my securities, the estimated street value is significantly higher than the face value. Is it time to sell bonds or these bonds? It could be, Larry. Remember, bonds go up and down in value. When rates come down, bond values go up like a teeter-totter. So because rates have come down and you bought these bonds years ago, you have a higher value on your bonds if you sold them today. The closer you get to maturity, that value keeps coming down and you'll get par value on your bonds when they mature. So what you have to ask yourself is this. What is the yield to maturity on the bonds I own? Some of those bonds might have even though you're telling me you get 6% coupon when you bought them, that's the face coupon. If the bonds are worth, let's say you paid $100,000 and now they're worth $112,000, your yield to maturity in 4 or 5 years might only be 0.5% because you got to take the yield off of the current face value or the current appreciated value, on those bonds. It might make sense to get a review of those bonds, sell some bonds, lock in a profit, redeploy that money in other areas that may have an opportunity to give you a higher yield on your money than what you're currently seeing on yield to maturity. Most investors, I find, Larry, do not understand how to buy and sell bonds. They think they buy a bond, they hold it to maturity. Sometimes that makes sense. Other times, especially now, a second opinion and possibly taking a big profit in your bonds before it evaporates makes a lot more sense to me. Sell from Marco Island, Florida. Where do you think oil prices are going? Would you invest in oil-related stocks like Exxon? Sal, that is an excellent question. You know, we're seeing oil prices around $50 a barrel right now. So they're well off their high of over 100. Oil prices are down over 50%. I'm starting to get a lot of calls on my TV and radio show, again, about oil and oil-related stocks. My opinion is oil is probably going to stay lower than it has the last decade or two because of fracking and technology. More supply and not enough demand to eat up that supply. That means lower prices. I don't think we're going to stay at $50 forever. Maybe we kind of base around this area, stay in this area, kind of trend around flat. Maybe over the next 6 to 12 months, we start to see oil prices go back in that $60 to $70 range. So this is what I would tell you. First off, I would not buy Exxon stock at all. I think Exxon's okay. It's a great company, but I don't think it's a great investment. You would have done much better buying the S&P 500, more diversification, and had a better return over the last decade or even 5 or 3 years. So the bottom line is I wouldn't have bought Exxon, and I think Exxon's not a great investment. If you do want to get in oil, though, I think the oil service stocks are a better opportunity. Not yet, because they're still in a downtrend. We need at least some confirmation that downtrend is stopped, and we start to see relative strength and some kind of an uptrend. You never buy at the bottom. You're never going to sell at the top, but you want to buy cheaper, and you want to wait for that uptrend to continue or start to gain process on the way up is a good way to put it. Instead of buying Exxon, be more diversified. Take a look at the Spider XLE. Don't buy it yet. It's still in a sell signal at our firm, and it's in a negative downtrend. But in the next month, 2 months, or maybe 6 months, it starts to come back a little bit, and that uptrend continues. Your first key indicator, the daily price is above the 50-day moving average. If that happens, that is maybe your first step to say, let's add a little bit to that, because you're starting confirmation that the trend is starting to resume back on an uptrend. Ted from Naples, Florida. What do you think of the biotech sector? How would you play it? Ted, great question. Biotechs and healthcare in general have been red hot. At my firm, we actually own healthcare-related equities in the ETF format right now, so that's fair disclosure, and we've owned those for a while, and I'm glad to say they've done quite well. That doesn't mean they're going to continue forward, but a trend is your friend. Relative strength is healthcare and biotech. Biotech itself, though, unrelated to the general healthcare stocks, is much more volatile and a little bit more expensive. If you do want to play biotech, the best place to do it is look at the iShares IBB. It's a broad basket. It's an ETF exchange-traded fund. It owns many biotechs, and you'll soothe out some of the ups and downs of buying just 1 or 2 biotech stocks. Remember, biotechs live and die, or the price lives and drops substantially based upon if they get approval on a new drug. Many biotech companies only have 1 or 2 drugs in their pipeline. If that one drug fails to meet approval, that stock could go to zero, out of business, you could lose all your money. Be diversified, look at IBB, do your own research, own in an uptrend, sell as the uptrend stops, and you start to roll into that 50 and 200-day moving average. I'm going to take a short break. If you have a question, send it to Brian Rezny at ReznyWealth.com. Make sure you visit my website, ReznyWealth.com. Download any of our groundbreaking reports. One of our reports that gets downloaded all the time, if you've been taken advantage of by the annuity charlatans of the world, somebody sold you a bunch of crummy annuities, find out why those are dangerous to your wealth and retirement. Go to ReznyWealth.com. Download for free right now why annuities are dangerous to your wealth, retirement. Don't be taken advantage of by the annuity salesperson who doesn't legally work for you. He only wants to line his or her pocket, and you're left at the back of the line. I'm going to take a quick break. I'll be right back after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, ReznyWealth.com, and download your free report right now. And we're back. I hope you're enjoying the first half of the show. Of course, if you have a question, send it to Brian Rezny at ReznyWealth.com. And you can also visit my website, ReznyWealth.com. Sign up for a consultation if you're concerned about the advice you're receiving. If you're realizing your so-called advisor that works at the bank or the brokerage firm does not work in your legal best interest, which most often they do not. They work under what's called suitability. If you don't understand fiduciary or suitability, go to my website, Protect Your Retirement, get real investment advice from a real firm. Download our groundbreaking report, Your #1 investment risk, fiduciary versus suitability. Most investors do not understand the difference, how to pick a real money management firm. They often hire a Wall Street firm, bank, or insurance company who doesn't legally work for you. Find out the facts before your retirement becomes a devastation on bad returns and losses. Protect your money. Go there right now. Jason from Fort Myers, Florida. Do you think Brazil will recover if oil prices come back? Jason, that's an excellent question. They probably will. Remember, Brazil itself as a country, they are so dependent on oil, and with oil really dropping over 50% in the last, let's say, 6 to 9 months, Brazil's been hit hard. They have high inflation, they've got some higher unemployment, interest rates are high, oil's down, that means they're not doing well. But yes, this may be the time where you want to start looking at Brazil as an opportunity. I wouldn't buy into it yet because, again, it's in a negative downtrend. All the sell signals that we would look at fundamentally and technically are there. So I wouldn't buy yet. You need some confirmation that trend starts to change. But Brazil may be an opportunity if oil prices start to level off and start to come back. And there could be the potential for outstretched gains. If you're looking at Brazil, look at an ETF, EWZ. It's the iShares EWZ. And it's a well-diversified ETF. I wouldn't buy it now, but look at it, research it, look at the trends. And again, one day Brazil should come back. It just depends when. But before they do, there could be more hurt in their stocks, their stock market. And if oil continues to stay lower, go lower, plan on their markets going quite a bit lower in addition. Rick from Cape Coral, Florida. What are the chances of a federal rate hike this year? I think very good. The economy, Rick, is actually doing well. We're growing GDP probably around 2.5% this year. I think the second half of 2015 that we're in will be better GDP growth than the first half. Unemployment's good, it's going down. Inflation's relatively low, probably lower than their mandate requires. So that would probably be the only reason that I would see they wouldn't do an interest rate increase. I anticipate September will be the first one, followed potentially by December again, but I think it's going to be very slow and methodical. A quarter point here, a quarter point there. Bonds will get hurt when rates go up, and bond mutual funds, any kind of bond, generally speaking, will get hurt. The equity markets can do well and have done well in previous interest rate increases as long as they're very slow and methodical, which I firmly believe if Janet Yellen starts to raise rates, it'll be slow and methodical. Don't expect Jimmy Carter Day rates anytime soon, but equities can do well. Bonds will ultimately get hurt. Larry from Miami, Florida. I've been avoiding the stock market for years because of risk. Is now the time to invest? Larry, I'm not sure why you're avoiding the stock market. I can tell you statistically, we literally get hundreds and hundreds of calls into our offices, my TV, my radio show all the time. Investors sometimes don't understand the risks of the stock market, or they worked with Wall Street. They watched their money evaporate 50% in 2000. They watched it evaporate again 50% in 2008. Again, are you getting real advice? Why are you scared of the stock market? What scares you? You should be scared of bonds if you own a lot of bonds more, in my opinion, than the stock market. Everything has risk. What you probably need to do is get professional help. Find a fee-only registered investment advisor firm, not fee-based. By the way, no Wall Street firm, bank, or insurance company is a fee-only firm. So you got to find an independent registered investment advisory firm. Fee-only is the only way to go. Real money management, fiduciary standard of care, legally work in your best interest. Go to ReznyWealth.com. You can always interview my firm to manage your wealth. We'd be more than happy to help you. We do have offices throughout Florida, in addition to Naples and Fort Myers. We're right local for you folks. Give us a call, schedule a consultation, find out the difference, protect your money. Lori from Naples, Florida. How do you pick a good advisor? I met with 3 and each one tried to sell me an annuity. Are you taking new clients? Lori, we are taking on new clients, and we do deal with a little bit larger investor. I will tell you that. You can go to my website, reznywealth.com, for more information, or you can call the number at the bottom of the screen. The problem you, the investor, faces is this. Wall Street, the bank, and the insurance guy who's selling annuities doesn't want you to know that they work under suitability. They don't want you to know that their interests are not the same as yours. They don't educate you because they don't want you to know. So if you're looking for a real advisor who's not just going to try to sell you the next crummy annuity with high expenses that robs your return and locks your money up, you need to hire a fee-only fiduciary money manager. If you go to my website, reznywealth.com, for free, you can download a free report and a questionnaire. You ask the questionnaire, the questions of the questionnaire to the firm you're interviewing. If they will not answer the questions quickly while you're in front of them, if they will not sign off as a fee-only fiduciary, it's a sales organization. You're going to be sold a bag of goods. Realize that. If you have a brokerage account, Lori, you're responsible to manage your own money, but most people don't understand that either. Go to my website. You'll learn about money management. You'll learn about who manages money, who doesn't, how to find a real advisor, how to protect your retirement. So again, go there, download that report. It's free. It's instant access. You can start using it right away. You can also interview our firm if you'd like to. We are a fee-only money management firm, and we are a true fiduciary firm working legally in your best interest. Rob from Fort Myers, Florida. Are you concerned about a market top? There's a lot of negative news. How do you manage risk? Rob, I am not worried about a market top currently, because remember, market tops usually happen from people who are overly optimistic, which we're not seeing, overexcited valuations. Remember back in 2000, the S&P was trading at 35 to 38 PE ratios, price to earning. Right now, the market's trading at about a 16 to 16.5 PE ratio. So less than half of what it was back in 2000. Valuations are reasonable. The economy's growing. We see no recessionary indicators in all of our research, so we don't see a market top. In fact, we see potential current growth in the U.S. economy, which could translate into higher equity prices if you're in the right areas, of course. So at the end of the day, the market news that you talk about, a lot of that's hoopla. It's negativity. People get sucked into too much news. It's the same news 24/7 today. You got to learn to avoid news that is not relevant to your money and look at quality information that you can utilize to manage your money for a profit. Most news is not good, and if you look at that and make decisions off a lot of negative news, you're probably not going to make any money with your portfolio, and you're going to probably make a lot of bad mistakes jumping in and out of things when you shouldn't. Dennis from Fort Lauderdale, Florida. Can you explain fiduciary versus suitability? Yes, a fiduciary firm, which would be a fee-only firm, that's the only true fiduciary firm, a fee-only firm. These firms have to legally work for you and legally always do what's best for the client under SEC guidelines. A suitability would be Wall Street, a bank, or an insurance company. So if you work with any Wall Street bank or insurance company, chances are you're working under suitability. Suitability means they actually don't work for you, that advisor or stockbroker, as they used to have been called. That person actually works for their firm. And they only have to give you advice that's suitable given your age and your risk profile. So as an example, they could show you a very expensive crummy mutual fund or an expensive annuity based upon your goals and objective, and suitability has been met. Once you're sold that investment, you then ultimately are responsible to manage and watch over that investment, although people think that's what the broker or advisor does. Under a fiduciary guideline and under a registered investment advisor agreement, a firm like us would always have to work for the client's best interest, always provide the best advice, always putting the client's interest ahead of our firm, and we actually would have to manage the money. Unfortunately, most people don't understand the difference. Go to my website, reznywealth.com. Download, if you want to learn more about fiduciary versus suitability, download for free your #1 investment risk, fiduciary versus suitability. It's a free report. It's at the bottom of the homepage. Instant, quick, read it. Utilize it. Protect your money. If the advice you're currently receiving is not working, if it's lackluster, if you're not happy with the performance of your portfolio, if you're just getting plain bad advice, get a second opinion. You can always call my firm. The number's at the bottom of the screen. Dave from Naples, Florida. I own no small caps in my portfolio. My advisor has me in large cap mutual funds only. Why? Great question, Dave. Your advisor probably is really not an advisor at all. Not owning small cap basically takes away from one of the biggest opportunities, in my opinion, to grow your portfolio. Statistically, again, no guarantee to the future, small caps and mid caps have outperformed large cap stocks historically over rolling 3 and 5 and 10-year periods of time, and often substantially. If I look at small cap outperformance over the last, let's say, 10 years, small caps have almost doubled the return of large cap. So why would you exclude those, or why would your so-called advisor exclude those in your portfolio? It makes zero sense. There's a lot of asset categories out there. Often what I find, the reason why a lot of people only are in large cap is because brokerage firms like to sell more large cap because people like to buy what they've heard of. You know, the Exxon Mobils of the world, the Apple Computers, or mutual funds that buy these big stocks. The problem is you're not looking at Apple Computer 15 years ago when it was a small cap company. That's when the real money was made. Not when the company's ginormous and they really can't grow as fast as they once did. Small cap companies can grow earnings faster than large cap, and often large cap companies buy small cap companies out to try and grow their earnings and revenue at a premium. So there's really a double catalyst why small caps can outperform and have outperformed large caps by a country mile. We own large cap at Rezny Wealth Management within our client portfolios. We continue to own those for many years. And in my opinion, if you want a chance really to grow some of your money, you need to look at small cap. Not all the time, but if you're neglecting looking at any asset category in your portfolio, you're leaving potential money on the table, and your advisor is not doing the right job, and it's costing you in real potential return. Too often, investors don't get the right advice. Is your portfolio performing the way it should? Ask yourself that simple question. Are you happy with the advice you're currently receiving? If not, call my firm for a consultation. Fee only, fiduciary, money management, which includes risk management. Folks, there's a difference. Don't settle with Wall Street conflicts, the annuity charlatan sales pitch. Do the right thing for your retirement. Protect your money from Wall Street, banks, and insurance companies. Call my firm for a consultation. There is a difference. We'll see you next week.